All right, everyone, welcome to video number 6. This is where we're going to start getting into how we are reading the higher time frames. So the algorithmic week is going to be a little different than what you're used to, um, for reasons being the algorithm and different delivery systems move at different times. It doesn't always start on Sunday. We use Wednesday. So Wednesday, 2 a.m. Central Time is the open of the day, and then the open of the week. So this indicator, everybody will have access to. Week starts at Wednesday, 2 a.m. to Wednesday, 2 a.m. Central Time. And that's how we're going to read delivery and look back systems. The delivery system of where market makers come in varies throughout the day. 2 a.m., 4 a.m., there's different pieces to it. But the correct system for the higher time frame during the week, especially with the 1 hour chart, is going to be Wednesday 2 a.m. to Wednesday 2 a.m. So that's how we're going to be reading delivery. When you start the day at 8 o'clock, so this indicator will give you the opening prices for 8, 2 a.m., and then some custom ones as well, where you can put 4 a.m. on and 8:15 to go along with the other indicator. This is where your look back is initiated, and this is how we start reading ranges. So, for example, here, this is the previous weekly range. So when we start here on Wednesday, which is a new week, at that point in time, we want to look back at the previous week to see what we did. What we're looking for is going to be imbalances left in the week and in the days. We're going to be looking for where we're at in reference to the equilibrium, the low, and the high. Those are the most important pieces of an algorithmic range. So this range here can be a 1 hour time frame, a 4 hour, the previous 2 hour candle. Those are all look back ranges that we want to pay attention to. So you read them the exact same way, everything being fractal. So when we're looking here and we open up, we can see that we're below the equilibrium of this range. When we look left in here, following the efficiency paradigm where every up candle needs a down candle to be balanced, we can now go through the week and we can look at these individual days and say, are there any imbalances that are left unfilled? Well, from here to this down candle is an imbalance in price. We want to keep our look back to the previous week, and depending on if we're leaving this range, then we can start looking at weeks beyond it. But our initial look back is going to be in this inside of this range. Because we're opening up inside of this range, then the imbalances and the liquidity inside of here become extremely important. So being in a discounted end of this zone, we want to see what happens when we go into premium, if we can start closing in these imbalances or not. Just like we read key levels, if we can't close these imbalances in, that may mean that we still need to drive lower for some failure swings or possibly take the low. But if we start closing in these imbalances, then we can look and find the next imbalances inside of the range we could possibly target. So when you're reading ranges like this, it's important to know where we start. Are we in the premium or discount end of the previous zone? Where are we in reference to the high, the low, and the equilibrium, annotated by this dotted line? And then we're going to look for our imbalances, our forms of liquidity, and we can see where we're coming from and where we need to go. So we can trade accordingly. That gives us our bias for at least the open, and we know what we can expect through the week. So if we're failing to close and take lows, that means we're finding support. This is where your 1 hour key levels come in, so you can get a broad overview of what we're doing. So for example, you can see this OGC right here has been holding up price. So another little keynote about a key level is that if it's been used before like this, then it's kind of proven its worth. So you can put more attention onto that type of key level. As long as we are respecting it the same way that we have been, just like we read our key levels, we're wicking without closing, which means we're not bearish. We left key liquidity here. So now this is following in line with we need to get into a premium end of the zone and fill some of these imbalances. You can do that every single day where we look back at the previous day to see what we've done. But you always want to have a good overview of what has happened in the previous week. So when we're here, if this is where I'm starting the new week, and I look back, we can see that imbalances have formed inside of the previous week. We've got a volume imbalance. A volume imbalance is a point in price with zero price action. So in order to balance this volume imbalance, it needs a down close candle and an up close candle to complete the price action here, because there's no price at all. So those are always draws on price, whether it's on a 1 minute chart, 1 hour chart, whenever there's a volume imbalance there, that's what that means. We usually hang out in there for a little while. But the key pieces to note here, we're opening up in a premium end of this zone. We've got resting liquidity and imbalances below us. So if we open and we fail to close above this high and continue going higher, then the algorithm is going to seek the equilibrium, the discounted pricing, and to see what's below there. Since we close below it aggressively, that's when we can start looking back a little farther or maybe move up a time frame onto the daily. But once you understand how to read ranges like this, that's why there's not a lot of need to go to the daily, the weekly, different things like that. We understand how to read key levels. We understand how to look back to a target. And then we just follow along as it's moving. This is when the time changed, so the indicator shifted a little bit. But same thing here. You can see that this week was a lot of a consolidation. But studying our fractal delivery, it looks like we had this. So we still need to expand above, following the order of delivery. When we open in the middle, we need more information. It continues consolidating, and then it ends up finishing the delivery from this fractal. So the more you study delivery, the more you can understand what this week is supposed to do or what it should do. If we start closing down here, that becomes invalidated. But you can see that the opening price of the week is always significant. We'll always reference it, either coming back to it or moving away from it. Those are more algorithmic key levels. But the key point to this discussion is how to start reading ranges. So this week shifted, so I want to start here. So we opened up at a discounted portion of this range. When I look back, there's imbalances inside of here. Since we are moving down at a rapid rate, we need to be familiar with our key levels so that we can decide what is most likely to happen. What did the previous day do? Well, we started moving up after an expansion down. We're moving up lethargically and leaving liquidity. So once we get to these key levels, if we can't close above them, then that means this low is acceptable to be taken. So as long as we look back and we understand that, then when we go into our day, we have key reference points that we can key off of to then confirm our direction on the 5-minute and then to enter into trades. Right here, we're opening up in the premium end of this zone. Expansions have been bullish, and we're in a short-term accumulation. So we want to see how we are trading when we get into discount ends of these zones. This opening price here is supporting price, so the previous week's open. Once we shoot down like that and we're failing to close below it, we wait for bullish order flow, and then we trade accordingly. As you can see, we close back above 2 a.m. Here's 4 a.m. We're going to use these algorithmic levels as support or resistance, just like we read any other key level. And the more you go through the days like this and the weeks, it'll start to make a little bit more sense. But again, once you have this indicator, take these ranges, see where we open, see where we went. We've got key levels up here, failing to close below 50% here. Tells me that we may need to move up a little bit. You've got failure swing here. We're wicking with no close. So this is telling me today this high may need to get taken. You've got volume imbalance here, which means we need up and down candles there. And then you've got some more key levels from previous day opens and things that you can reference up here. So when you're starting your day, always look left where we're at in reference to the previous day and the previous week, because this range is going to dictate where we're going forward. Here, you can see this week shot up and we never came back to it. This is a really large imbalance that needs to get filled. Here's a failure swing. We are wicking with no close, which means we're buying that level. So that tells me that we're still moving up. But once we break down, this is an area of interest because you have a large imbalance that we could come down to close because we need a down candle's close there. Wait for signs to being bearish, and then we go. But these are areas of reference for you on the chart constantly from when you're starting your day. Even this random day, 2 a.m. opening price, tap and go. This day opens, we look left, we've got a large expansion down. So it's permitted and likely that we may get a retracement. So when we start our day at 8 o'clock, which is right here, we can trade accordingly. And this is how we follow the higher time frame or the 1 hour based off of look back and ranges. And we'll dive way deeper into ranges in the live education every single day. But those key points is what you need to be looking at. So the next one, I'm going to talk about the overnight session, which is another range that you're going to look at for the day. But this is the overview for the 1 hour. Thank you, and I'll see you in the next one.